Let's talk about one of the simplest but most powerful trading rules. Buy low, sell high. It sounds basic, but once you connect it to how price actually moves, it becomes a game-changing strategy. Let's start with an uptrend. Picture this. Price is making higher highs and higher lows. A strong, healthy uptrend. After a big push-up, price usually pulls back. Now, this is where we want to step in and look for buys, but not just anywhere. We want to buy when price is cheaper, when it's giving us a discount. Here's how we find it. Grab your Fibonacci tool. Measure from the lowest point to the highest point of the move. Now watch where price pulls back. If it pulls back to around 50% or deeper, that's what we call the discount zone. This is where you're getting a better deal and giving yourself a much better risk to reward on the trade. Alright, now let's flip it and talk about a downtrend. Picture price making lower highs and lower lows, just a steady move down. After a big drop, price usually pulls back up a bit, but this time we're not looking to buy, we're looking to sell high. Same idea. Grab your Fibonacci tool, but now measure from the highest point down to the lowest point. If price pulls back to 50% or higher, that's your premium zone, the sweet spot to look for sells at a better price. So, to keep it simple, in an uptrend, you want to buy in the discount zone. In a downtrend, you want to sell in the premium zone. Once you start trading this way, combining market structure with premium and discount levels, your setups will make way more sense, and you'll feel a lot more confident taking your trades. Alright guys, now let's put everything together. This is where it all makes sense. Start by picking any high point. I'm starting from here. You can see price starts moving down, and we expect the market to form lower highs and lower lows, showing us a bearish trend. After a while, price pulls back. So now grab your Fibonacci tool and draw it from the high to the low. Here, price retraces to the 38.2% level and even taps the 50%. That tells us this is a valid pullback. So we go ahead and mark the weak low. Since the market is still pushing down, we expect bearish continuation, and eventually, price breaks lower, giving us a break of structure. That confirms the downtrend. Now, we need to mark the strong high in this move. To do that, draw a horizontal zone from the weak low up to the breakpoint. Extend that zone upward and find the highest point inside it. That's your strong high. Then price pulls back again. So let's check if it's valid. Use your Fibonacci tool from the strong high to the new low. You'll see price comes back to the 38.2% level and even hits the 50%. That's another valid pullback. We mark the new weak low, but here's where something shifts. Instead of continuing down, price breaks above the previous strong high. That gives us a change of character. Because of that break, the weak low now becomes a strong low. The trend has flipped. We've moved from bearish to bullish. After the change of character, price pulls back again. Use the Fibonacci tool from the new strong low to the new high. Once again, price retraces to the 38.2%, confirming a valid pullback. So we mark the weak high. Price pushes up, breaks the weak high, and gives us a break of structure. As always, we mark the strong low, the lowest point before that break. Now price pulls back again. Use your Fib tool from that strong low to the high. But this time, price doesn't even touch the 38.2% level. That tells us it's not a valid pullback, just a continuation move. After that, price keeps moving up, then pulls back again. And this time, it does reach the 38.2% level, maybe even a bit deeper. So now, it is a valid pullback. We mark the weak high. Price then pushes higher and breaks that weak high, giving us another break of structure. So again, we mark the next strong low, the last low before the break. Price pulls back again. Use your Fibonacci tool from the strong low to the new high. This time, price touches both the 38.2% and 50% levels, so it's a valid pullback. We mark the weak high. Now, here's the twist. Price was moving up, but then it breaks below the strong low. That's a clear change of character, which means the market has flipped back to bearish. Because of that, the last weak high now becomes the strong high. To mark it, draw a horizontal zone from the strong low to the break, extend it upward, and pick the highest point in that area. That's your new strong high. Price drops sharply. After some time, it pulls back again. So, grab your Fibonacci tool and draw from the strong high to the low. Price comes up to the 38.2% level. That's a valid pullback. We mark the weak low. Then, price breaks below that weak low. That's a break of structure. So, we mark the new strong high, which is the highest point before the break. Next, price pulls back slightly. Use your Fibonacci tool again from the strong high to that small pullback. This time, price doesn't reach the 38.2% or 50%, so it's not a valid pullback. It's just a continuation move, and price keeps falling. Eventually, price pulls back deeper. Use the Fibonacci tool again from the same strong high. Now, price hits both the 38.2% and 50% levels, so yes, it's a valid pullback. We mark the weak low. Now, why is this important? In a downtrend, we expect weak lows to break. That's the logic behind market structure. In an uptrend, it's the weak highs. Later, price breaks lower again, giving us a clean break of structure. So, we mark the new strong high, which is the highest point before the break. And that's the process. Follow these steps consistently, and you'll stay in sync with the market. A lot of traders ask me, which time frame should I use? Here's the answer. It's not about the time frame, it's about the structure. Whether you're on a 4-hour, daily, 15-minute, or even a 1-minute chart, the way you read market structure stays the same. The key is consistency.